What's going on, y'all? And welcome to another edition of Weeds Weekly with yours truly, Kevin Weedmark, where I'm going to break down what happened last week in the market, what we can anticipate for this week, and boy, do we have a big one. We have the presidential election tomorrow. We also have the Fed policy meeting on Thursday. We're also going to be talking about they're back. And what am I talking about? I'm talking about Buydowns. I know it was just probably about a month and a half ago I was saying to forget them, but make no mistake about it, they're back in full force. And the last thing we're going to talk about is down the stretch we come, right? One of the biggest questions I continuously get from anyone I speak to in this space is what do I think the remainder of 2024 looks like, especially with the election and so on and so forth. So let's just cover what happened last week. And the biggest thing that's glaring to me right now is traders' fear of long-term inflation. Look, you have a U.S. national debt that's over $35 trillion, right? So that's number one. Last week, we had non-farm payrolls come out. And what we saw in that data is we saw wage increases. And what we're seeing is a healthy labor market as well, which means more dollars chasing fewer goods. That is inflationary, as well as the government cannot stop spending money. And it looks like neither candidate really is concerned about that. And I've mentioned that before. That is weighing on traders' minds, and that is why we are seeing higher interest rates right now. Even though the Fed is reducing the Fed funds rate, there's no direct correlation in that regard. That is short-term rates, that's not long-term. Traders are just overly concerned with what does the long-term picture look like for long-term inflation. And therefore, we're seeing increased rates and we're seeing them remain elevated from where we had anticipated. And let's just look at it. In the last 46 days, since September 16th, we have seen the 10-year Treasury increase 0.768%, which is correlated to interest rates increasing anywhere from 0.5 to 3/4 across the board. That is a massive increase in the last month and a half. And what we have seen, with the election, coupled with the election, so we already knew going into October that historically that is one of the slowest months, combined with interest rates skyrocketing that fast, and we've just seen things come to a screeching halt, right? So that is what we are seeing, and that's what I think we can continue to see here in the short term. The other thing is, hey, excuses. I mean, on Friday, we had the release of the non-farm payroll. It came in at 12K, and everyone basically just acted like it didn't even happen, which was shocking to me. Although we did have, obviously, the two hurricanes, you have the layoffs of Boeing, but 12,000? I mean, is everyone affected by the hurricanes? Is that across the country? I think that number was really low, and I think that obviously the traders are anticipating that may get changed. We may see that get revised higher given the months ahead. So the market actually just brushed it off as if it didn't even happen, which I was pretty shocked at. I would have thought that maybe we would have saw a little bit of rally in the 10-year Treasury. So let's look at what we have coming ahead. And look, this is a huge week. The presidential election, we've been waiting for this now for months and months and months. And obviously that directly affects the real estate market, just with people in quicksand, the uncertainty and the growing concern that possibly you could get a red or a blue wave, and then you got one party controlling all branches of government and so on and so forth. So look, the election is huge. The major concern I have and that I'm really focused on is when are we going to know the results? Because the longer this drags out, the longer that we in the real estate business stay in uncertainty, and that is bad for business and getting people off the fence and getting people moving. And unfortunately, we've already had numerous states come out and indicate it's going to take days, if not a week, or possibly weeks to count these votes. And it's insanity to me, given that the modern technology that we have today, that some states can actually do it right there and then that day, and you have other states that are just taking forever to count votes. But again, I'm just stressing that, look, even though the election's tomorrow, unless there is a clear runaway winner, this could drag out, and we need to be ready and anticipate that could potentially happen. And how are we going to react and call our clients, and what are we going to say? The other thing that we have big this week is the Fed, right? The Fed is going to do what the Fed does. They've already said, hey, they're locked and loaded. They're going to reduce the Fed funds rate another quarter. Unfortunately, I think they should pause. I don't think they should do a damn thing. I think they're already giving clear indicators of long-term inflation uncertainty, as I already talked about. That is bad for the market. I do not see why the Fed needs to do anything with a labor market that seems to be fairly stable. It's not really running away. It's not aggressively growing. And we have also long-term inflation as a concern. I think if the Fed just paused, they could then get aggressive in December if they needed to, especially after just seeing the 12K number with non-farm payrolls that the market didn't even react to because of the hurricanes and the strikes. So I'm a little bit concerned in that regard. I don't really think that we need to do anything, but again, the Fed's going to do it. So what does that mean, and why do I expect some major potential volatility? Well, it's because we have a day before the election that all the traders get to kind of move and kind of hedge of what they think tomorrow is going to play out. Now, there's no clear indicator tomorrow. It's not going to come out till tomorrow night, so it's kind of a 2-day thing. And then you have Wednesday. You have basically the results potentially of what's it's going to look like. And remember, they're worried about all three branches. So it's not just the presidential election. It's going to be, well, who now has the potential to be in control of the House? Who has the control of the Senate? And so on and so forth. A lot of that's going to be coming out on Wednesday. Plus, that is the day before the Fed. And the biggest thing about the Fed is everyone's already priced into the market the quarter point. It's, does the Fed actually react to the presidential election results, to the election results, in what they have to say in their statement? I don't think they will, because they're not supposed to, but shit, as I've talked about before, look, I think every branch of government is political in some way. I would not be shocked if something comes out and they say something that could move the market one way or the other, or they change their course, so to speak, and where they anticipate the Fed funds rate to kind of fall moving forward based on the election results. So to me, this week has the potential to be huge in volatility. And what do I mean by that? I think you're going to see some highs and lows. You're going to see some drops and you're going to see some increases. It's going to be a really interesting week, and it's going to fall into next week as well, as I believe the election results are going to be drug out a little bit. So just be prepared for that. The other thing that I wanted to talk about is, look, 2-1 buydowns, they are back in style. Make no mistake about it. I've talked about it before. The magic mortgage rates where people want to be to make moves. They had a study that came out. It was in my previous articles. About 50% of people, both buyers and sellers, would be willing to make a move if they could get to interest rates in the 5 to 5.5% range. And lo and behold, with a 2-1 buydown, that is exactly where you would be. So once again, depending on your marketplace, depending on where you are, it's going to be different. You need to know your local market better than not, but more common right now, especially in a market that is saturated a little bit with inventory, seller concessions are part of the equation. They are part of the equation up to 3%. That buyer can then use that to do a buy down. They can use it to pay some closing costs. And in a competitive marketplace, we as real estate agents should be talking both to buyers and sellers about seller concessions, what that can mean, how it can move a potential property faster, what it can do for a buyer, what the buy down does, and so on and so forth. Because again, you're also competing with new inventory, right? You've got new builds. New home sales have been one of the bright spots of the real estate industry for all of 2024. So again, you have to be competitive against that space. And if you want your house to stand out, you need to be offering buy downs. But you need to be doing it through seller concessions and in your advertising for that house. I'm telling you right now, agents, you need to have flyers that are made up that are talking about these buy downs. What is the potential interest rate? What is that potential payment? Look, just as always, buyers are visual. They want to see those numbers. So if I can be of any help, let me know. But they are back in style, and I believe that they're going to be in style for the rest of this year. And again, I know 46 days ago, I was saying that it was over. We didn't need them. You should be reducing the purchase price, using it to fund escrows. I stand corrected. I didn't see that rates were going to go up this quickly, this fast over 46 days. So once again, 2-1 buydowns are back in fashion. We went from 1-1, we're now down to 2-1. And lastly, down the stretch we come, right? As we're looking at the remainder of 2024, what can we anticipate? And I just covered it on a few topics. And number one, it's inventory levels. I think they're going to remain fairly stable. I don't see big spikes and I don't see big decreases. I think this election is going to drag out for a little bit, the results of this election. I think, as polarized as we are as a nation, I think whatever the results are, I think that's also going to have some people in quicksand. And I think just your inventory levels based on higher interest rates, you got the lock-in rate effect still going. I think inventory levels are going to remain exactly where they are because I do not think that you're going to get sellers coming into a holiday season. You're not going to get a big uptick in listings. Everyone's going to be waiting for 2025. So again, I think inventory levels, if anything, have the potential to come down in some of these saturated markets. So what we have right now on the table is I think what we're going to get a lot of. I don't think you're going to see a lot of new activity in that regard. Interest rates. Unfortunately, in this one, guys, I think, and gals, I think that it has the potential for the rates to go up. I'm looking at, it's almost like deja vu from last year. If you recall last year, October, we were at 8%. This year, now we've spiked up to 7%. And we saw it gradually come down last year as the Fed then anticipated that inflation was under control. I think we're in the opposite environment. As I've already talked about, long-term inflation is a huge concern. I think it becomes a growing concern depending on who gets elected. I think either way that goes, the fear of more spending by our federal government, I think, grows. And I think that's a potential problem. And I just also believe that we're seeing the data come out consistently that inflation is a little bit stable. It's not decreasing. If anything, it looks to be ticking up ever so slightly. You have wage increases, you have a stable labor market, and you have a Fed that's reducing the Fed funds rate. I think that all spells for slightly higher interest rates. You're going to see peaks and valleys along the way these next couple months. But I think that we possibly end the year, honestly, anywhere from about 7.25, maybe to 7.75. I think we're lucky if we get down to 6.5% again. Very lucky. And I just don't think that happens. So I think we need to be prepared for these higher interest rates, which is why I just talked about buydowns. I think it's critical that we're talking to both our buyers and sellers so that they know what seller concessions they need to offer, how effective buydowns are going to be to move property. The other thing is the labor market. I see it being fairly stable. I think it's going to get a little bit convoluted because, once again, we're coming into the holiday season. And what do we see? We see a lot of short-term hiring. We see a lot of part-time hiring. And those numbers get a little bit skewed. But we are coming into the holiday season. We anticipate that this to be one of the most robust spending dollars-wise for a holiday season. So I expect much more from the labor market. I don't expect to see huge spikes. I expect to see it to be fairly stable. And, looking at anywhere about 220,000 for non-farm payrolls, it's not earth-shattering by any stretch of the imagination. I think we could potentially see a slightly higher uptick in unemployment rate. And I think GDP continues its downward trend a little bit, which I think the Fed's going to keep an eye on. But again, I just think it's one of those things that the consumer in the background is not purchasing the big ticket items. I think everyone is starting to really feel the pain of inflation. I think overall spending's good, but I think as we come out of this holiday cycle, I think we're going to see a significant drop in that. And the last thing is, I think, closed sales. Unfortunately, as we close out 2024, I think it's going to be less than it was last year. Last year, we were running into rates coming down from that 8% mark. People were feeling a little bit good about 2024. The Fed was talking about decreasing interest rates. Everyone was kind of getting on board with that mantra. I think we got the exact opposite this year. I think depending on who wins the election, the media will paint this rosy picture or a dire picture of potentially what 2025 can look like. And I think that may play into it a lot. But I think the higher interest rates that are going to be there, that are going to be solidified for the remainder of this year, as well as I said, possibly on the upward tick ever so slightly, I think is going to unfortunately decrease sales for the remainder of this year. And we're going to have to look at 2025 as the year we're looking to bounce back. So that's my assessment for the rest of this year. I think that could potentially change, obviously, with the election. I'm kind of putting my neck out on the line. But again, I don't really care. I analyze this stuff all the time, study it a ton. So, hey, if you're wrong, you're wrong. And if you're right, hey, it's great. But you can always change. Everyone have a great week. You need anything, you need a flyer, you want to talk about these buy downs, you want to talk about how to approach a potential client. Look, I also own a real estate company. I work with agents. I know I'm in your shoes as well. So please don't hesitate to brainstorm with me. I'm always happy to help, and I'm a phone call, email, or a text away. Everyone have a great week. Happy selling out there, and I will talk to you on Friday with a Friday wrap up. Cheers.